Good evening, everybody. Hope everybody's having a nice fall evening. Tonight we've got the great pleasure of having Eric Wilkinson with us, otherwise known as Wolfman, and he's going to show some of his trading techniques, and this is coming from somebody that was actually on the floor. So with that, Wolfman, welcome to the Candlestick Forum. We're anxious to see your information tonight.
Thank you, Stephen, for having me here, and appreciate everybody here in the Candlestick Forum for sticking around for me on this day, on Thursday. A little bit late probably for some people on the East Coast, but I hope I can streamline some of your processes. You know, when we're looking at options in the option montage, it can be a little overwhelming, like looking at a fighter jet cockpit. So what I'm going to try and do is streamline that process so you guys can focus your eyes on certain aspects of that option montage and make it a little bit easier for you guys down the road when you're looking at probabilities and everything else, with Stephen giving you guys candlestick setups. And what I'm trying to do is find a high probability strategy in and around something like that for those assumptions we come up with from reading those tea leaves. So these are floor trader hacks. These are some of the things that we as floor traders needed to have in our repertoire on a daily basis. It's not drilling down on the minutia and finding the exact decimal point for everything. What we needed to do is quickly look at something and get information from it and move on with our lives, just like you guys are doing when you guys are trading. You don't want to be pulling out a pen and paper or calculator and your TSR 50 LR plus calculator. No, we're trying to do this where we can just glance at something and come up with some data from that information. But a couple of things, like Steve mentioned, I was a floor trader, and some people may recognize me as a Wolfman from CNBC, Fox Business, or the Wall Street Journal. I used to do some market commentary, economic and geopolitical analysis on some stuff. I'm clicking on the wrong slide there. So in that time, I've traded everything from stocks, financial futures, commodities, currencies, and options on all these products and just about all market conditions. So let's get on with it. Floor trader hacks for options. This is really what we're drilling down on, the nitty gritty. Yeah, no, this is not what we're going to be looking at today. I'm just kidding. Some people's minds are probably starting to blow up right now. What we're going to do is these are three things that I want you guys to take away from today, and it'll help you streamline your process, you know, and create some calmness. The first thing is we're going to try and spot when options are expensive and when they're cheap. That's really important. Why? Well, you want to buy things that are cheap and sell those things that are expensive, right? So we need to figure out whether the options pricing are cheap or when they're expensive. All right, we're also going to need to know our probabilities, all right? The probabilities are important. Why? Because they're going to actually keep us calm, stay mechanical, all right? We're going to be able to take the guesswork out of these option strike locations. So we're going to be able to do that. And ultimately, we want to be able to find what the best strike location is, given we're going to be buying an option or selling an option, all right? And knowing the likelihood of what the option strike probability is of being in the money or even out of the money. And I'm going to show you really quick things. We're not going to do a ton of math here, but one of the first things I want you guys to learn is spotting options when they're cheap or expensive. All right? And yes, that is that same mathematical equation here. Now, for some of you that want to really drill down on the minutia, this is something you guys can use. You can put this as a sticky note on your platform or on your window there. Just kind of write it down really quickly. I'm going to show you a really quick way to come up with this, though. But if you want to really drill down on it, that's what we want to look at. We ultimately want to look where this current IV is in relation to where the high and the low is. Ultimately, that will tell us if the current implied volatility is near the high, we know those are really expensive. And if its current IV is very close to the low or at the low, it is currently the low, well, then you know it is the cheapest. Those premiums have been in the last, say, 52 weeks or so. So ultimately, when we're looking at a chart, we can kind of forget about all of this up here. What I really want you to focus your eyes on is right down here at implied volatility. And ultimately, we look at this implied volatility number and see that the location is right there, right? What we want to know is in relation to where it's been in the past here versus where it is currently, or the low. So, you could draw a line across the bottom. I believe that, we haven't seen this kind of volatility across the board in, I don't know, probably 30 some odd years. I think 1984 or 1987 was the last time we saw a spike like that. That surpassed the spike that we saw even during the financial crisis. So, one of us or some of us could say, that is an extreme outlier. So ultimately what we see is implied volatility has a tendency to stay within a range. And those aren't great lines, but we can see that once it gets up near these levels, it has a tendency to revert back to the mean, all right? And when it gets down towards these lows, it has a tendency to start migrating back up. So we know down here that if the implied volatility gets that low, those are really cheap premiums, all right? And when they get up near these highs, that's really expensive premiums. So we could say that right now, currently, BABA is experiencing pretty expensive premiums, unless you think that we're going to have another crisis worse than Corona in the next, couple of weeks. I believe that, that outlier is a bit behind us. And we are going to experience some high volatility, probably at least for the remainder of 2020. Now, I'm sure Steve probably isn't doing candlestick setups for, 3 years out, right? Most of us are a little bit shorter term traders than that, maybe a couple of months or so. So in that regard, this volatility currently is probably the ranges that we're going to see for the foreseeable future. Now, BABA, we can see in this picture, is pretty high volatility, but then we flip to the next slide here, and we can see that for Kroger, that volatility is relatively low, and one could say it's probably at the lowest level it's probably going to be going forward. Yes, last year it did get a little bit lower, so we may need to keep that in mind, but ultimately we could see that if we were doing a strategy around Kroger, and I'm not necessarily giving you guys a directional assumption at this point, but if you thought that Kroger was going to continue to the downside, well, then you would be looking to buy options, right? And in that case, you would be looking to buy puts. Now, if you thought it was going to rebound at this point and start going back up, well, then on a directional assumption that was bullish, you would be looking to buy calls. And on the flip side, when we go back to, if we were to go back to the BABA trade, that it's a completely opposite trade, right? You're looking to sell premium because those premiums are elevated. So ultimately, what I want you guys to take away from this option hack is when we're looking at implied volatility, we're just looking at a chart like this at the bottom where we have the implied volatility. We can forget about, you've already assumption based on your chart setup, but what we want to look at is where this implied volatility is, because that is what will determine whether we're going to be buying an option strategy or selling an option strategy. And obviously, in this case, we would be looking to be paying a debit for whatever directional assumption we have, because it's cheap. The premiums are cheap anyway. So why is this important? I kind of got ahead of myself here, but because when volatility is high, we want to sell that premium, and when volatility is low, we want to be buying that premium. So very important to just know that little hack. Easily, back in the day on the floor, we didn't have a chart. We had to kind of figure that stuff out in our head. We knew where current volatility was, we knew where the high was, and we knew where the low was, which is why we had that equation that was relatively easy to come up with and discern whether it was above 50 ultimately or below 50. So that's the line in the sand that we're looking. If we assume that the market is going to come back to, sorry, let me go back one more. if we assume the market is going, when it's at extreme lows, want to start migrating back higher, it has a tendency to want to revert back to the mean or the middle of the road. So, above 50 you sell. My pen doesn't want to pick it up. And below that 50 you want to buy. So you can kind of just draw those lines in the sand, or if you have a charting system, you can draw straighter lines on that. But we want to buy when it's below 50, and above we want to sell. All right. So that's why that is important. So sell premium above 50, buy it below. Everybody with me right now? Somebody's clapping. All right. Good enough. All right. The next thing is understanding the relationship between delta and standard deviation. Yes, I don't want to blow your guys' minds out of the water. I'm going to make this concept simple. But what everybody usually talks about is delta is the amount those option premiums are going to increase or decrease in relation to the underlying moving $1. But what I want to talk about is really what delta is as a probability. So delta equals the probability of being in the money. And this is in the money at expiration by 1 penny. So that strike that you're looking at expiration, on the day the strike or the expiration happens, that strike is in the money by 1 penny. All right, those are the probabilities at the expiration. So when we're looking at that and we go forward, so for instance, if we're just looking over here and we are looking at an expiration cycle on these SEP calls that are going to, or SEP call side, that are going to expire on the 16th of the month and 25 days to expiration. This is an old one, but I wanted to do this with a high price stock so we could see a lot of different deltas here. So we can see that all of these strikes are having a correlated delta. This delta says that in the next 25 days, or in 25 days from now, these strikes have that probability of being in the money. So 51% probability of being in the money in 25 days by 1 penny. And 47% probability. Same for on the put side. We can look over here and say, the strike here is going to have about a 42% probability of being in the money by 1 penny. And that is on the day those strikes expire. So we can figure out what our probabilities are really quickly when we're trying to come up with an assumption whether if we buy an option strike, right? If we bought something around the 31 delta, we would know that we have a 31% probability of being in the money in 25 days. All right? It doesn't mean that, it comes up into the money and then comes back out of the money. That can happen as well, but we're talking on that expiration cycle. So, finding the best strike. We're going to look at this formula. No. I want to go over to the standard deviation curve. And we can look at this as if, think about this as the call side here. We got calls and we've got puts. All right. And, right now, let's just say XYZ is trading at $100. All right. So that's right here today, right there in the middle. Now, on a standard deviation curve, if we looked at this strike right here, we could say like this is we're going to go puts to this side, so the 95 puts, the 90 puts, okay? Just as an example, on the flip side, these would be like the 105s and the 110s. All right, moving higher. So a half a standard deviation to the downside means that the market could go down, but it's not likely, and it could go back up, right? So the probabilities of all of this happening in the next 25 days is about a 69% probability of happening. All right? which means, you add up all of these numbers here along the lines, and we're basically going to come up with somewhere around 31% probability. All right? And on a little bit further, we go down here, and we're going to be looking at this as about a 16% if we added up all of these numbers below. So it's only a 16% probability there. This is a 31% probability going there. Now, why is that important? Well, believe it or not, standard deviation curve really lines up with the delta, because this is all probability, right, of what's going to happen. If you guys remember back in the day when you'd have a grading scale on a curve, well, the same thing is with the option. The deltas really correlate to the standard deviation curves. Yes, it can be skewed. I don't want to get into all of that. It can be bent. When a volatility increases, you can think about it as a big bucket sitting on top of this arc. And the more the bucket gets filled up with volatility, it squishes down this curve, and those probabilities get stretched out a little bit further. When there's no volatility in it, it gets really skinny because it starts. There's no pressure on the downside, down on the curve. So something to think about is being the way that volatility really affects those probabilities. Now, we don't really want to talk about the further out ones. We used to say when you're dealing with those further out standard deviations that it was like standing in front of a steamroller and picking up pennies. All right, if you're buying those way out there, you're kind of throwing money away. And if you're trying to sell those, yeah, you can collect some money quite often. Your probabilities are pretty good, but when it goes bad quickly, and it feels like you're stepping in front of a steamroller. So ultimately, we want to look at the one standard deviation and the half standard deviation here. And these are the key strike locations for options. Some people will talk about buying in the money options because your probabilities of being in the money are greater, but the fact of the matter is your probabilities are still your probabilities. It's still a 65% probability of being in the money, but it's a 45% probability that it won't be. So you can lose more money by doing the in the money options as opposed to doing the out of the money options. All right. So why are they the key locations? Well, if we are going to be looking at the option, back to the option montage here again, the idea here is we want to play the probabilities. And when I was talking about, like, say, for instance, a 31 probability here, that's the one that I'm going to be looking. If I were going to be buying a call on a bullish move, that would be the strike location I would be looking at. Now, if I was going to be buying the same in the money probability, we talked about 69% to the one side and 31% to the other side. Well, if I have a bullish assumption, yes, this does have a 61% probability of being in the money. But if I'm wrong, and that's only by 1 penny. So that means the market could come all the way down here, and I would lose all of that premium. Whereas if you look, here's another real quick option hack. If you look at the corresponding puts to the in the money calls, that's your floor trader hack for extrinsic value. That's what the option will decay. And you can see it's the same as the one that I'm playing here. So if we're just playing for extrinsic value here, I'm only worried about my extrinsic value here, but these ones that are in the money, I'm worried about intrinsic and extrinsic value. So I can lose more if I'm directionally wrong and the market starts going down. I'm going to be losing all of that premium, whereas here I'm only going to lose on this end. Also, to the upside, my probabilities are pretty good for being at least tested, which we'll go into another floor trader hack here. So our probability of the market during the duration of this option expiration, delta times 2 is our probability of being tested. Or on the floor, we used to say your probability of being kissed. You had 2 times the probability of being kissed rather than being in the sack, if you will. So the probabilities of your strike going in the money, we already knew. Say, for instance, I was looking at the 31 delta, right? Well, during the life of the option, I have a 32% probability of my strike being touched, or the market comes up and just clips my long call in the example I was giving there. So we can go back and look at the option montage, same option montage here, and say that, if we're looking at this same 31 delta here, well, during the next 25 days, I have a 62% probability of XYZ, let's just call it XYZ, trading all the way up here and hitting my, I'm kind of having trouble seeing here, I think that's a 765 strike. So there's a 65 or 62% probability of the underlying rallying up during the next 25 days and trading 765. So it can come up, hit it. It doesn't mean it's going to be in the money, but it has a pretty good chance of coming up there and clipping that strike. Same for instance when we were looking at this in the money one, right? So this one has those same probabilities. It has still a 62% probability of the market coming down and hitting that strike. Now that's going to feel pretty painful while you're watching this, $18 debit go to zero or very close to it, maybe down to a couple of dollars during the next 25 days. But when we're trying to stay mechanical and staying in this game for the long time, this will help you stay a little bit more mechanical by trading these ones that are slightly out of the money and playing it for, all right, I've got a bullish assumption in XYZ, and I'm sure when Steve comes up with these candlestick formations, you guys are looking at Fibonacci's and other things as well, but you have like a basic assumption as to where you think this market is going to rebound to. And a lot of times, I would guess that it's probably going to kind of land somewhere within this delta bullish assumption. So why not pick those strikes rather than the ones that are in the money and paying that extra money? Because if you're directionally wrong and it starts moving against you, it's not going to hurt you nearly as much. You're going to stay calm. You'll be able to stay in the game a little bit longer and play the probabilities out a little bit more. So that's why I like when I'm buying a call, I'd like to buy the calls that are around the 31 delta. It's got a pretty good probability of being tested, 62% probability of being tested. And, when you're doing your chart setups, your probabilities of your directional assumption are much better when you entered at a good strike location, right, or a good entry point. And then on the flip side, I like to sell those 16 delta calls or 16 delta puts, Why? Because even if I get tested on those, I know that being in the money at expiration is only a 16% probability, pretty low. And, I got only about a 32% probability of being tested. Still pretty low. So it helps me keep my powder dry, knowing those probabilities of that strike being in the money or being tested going into the trade. I'm sure Steve talks about this all the time. It's one of the few things that we can really control is our entry points and our setups. So those are the make or break points on trading. When we get into a good strike location, that helps us increase our probabilities of success and helps us stay mechanical. Because the last thing we want to do is start getting emotional. And the hardest thing with trading is it's a bit emotional. Why? Because we correlate it to money so often. And if we can stop thinking about this as being related to money, and we shelved that, one of the first things that somebody ever told me on the floor was when he was like, how's your day going? And I was like, I'm up this much money. And he just looked at me and just shook his head. And he was like, dude, you got a long way to go. He was like, until you can stop thinking about it as money, you can't really consider yourself a real trader. Real traders think about it as probabilities and entry points and exit points, and you follow that to a T. You stay mechanical. You're like a machine. And And that's true. And once you start doing that and playing those probabilities, you will be feeling much more comfortable when you're getting involved in different stocks and trading. All right. So what's the expected move? We can figure this out. Volatility is going to determine this, but I don't want to have to like blow your guys' brains away by doing more math and doing square roots. Like, who wants to really think about that? So one of the things that we had, on every piece of paper basically, and you guys can write this down for a sticky note. This is a great way to streamline the process. You can take with the current implied volatility, going back to that implied volatility chart. So knowing where that is very important. And if you're looking at a one-day move, you take that current implied volatility divided by 19.1. 1 week is current implied volatility divided by 7.22, and for a month divided by 3.5. Now that's if you want the minutia. You guys are probably like, the Wolfman, you use way too much math. That's the last thing I want to do. But going back down here, we can look at this current implied volatility as 44, right? Now, if we did the sticky note, the 19, the 7.22, and the 3.5, I haven't memorized at this point. But we could see where, if we had a candlestick set up, what the probability is of it having an exponential move in either direction, depending on what your directional assumption is. So if we flip out and forget about the chart for right now, we can look at this as taking this 44, right? We take 44 and divide that by the 19.1, right? And that would basically equal basically in the next day we're expecting a 2.3% move in that underlying. So if you multiply it by the underlying price, let's say it's 25. So if you multiply that by 25, then 62, which is what my chart was saying on the other slide, or 63. Basically, you're going to be talking about a 59-cent move within the next 1 day. Again, if you went to 44, it's pretty simple. You can divide that by the 7.22. And basically, that's going to equal a 6.09% move. All right. And that's in the next week. Multiply that times the underlying times the 50 or 25, 62. All right, and that's going to equal, it's basically telling us we're going to have in the next week plus or minus $1.56. All right, plus or minus. It can go up or down by that much. All right, helps us keep our powder dry, right? Again, if we go further and we do the 44 divided by the 3.5, right? The 44 divided by the 3.5, we're going to basically be looking at a plus or minus 12.5 percentage points. All right, times that 2562. I'm going to get somewhere else besides all of this in a minute. So basically, we're looking at a $3.22 move in the next month. Well, we're looking at an expiration cycle that's around 25 days, right? Well, it's important to understand those moves because we really want to look at if we're buying options or selling options. Say, for instance, I want to sell options. I'm going to be looking at that 16, 17-ish delta, right? So I want to know whether or not my 160 calls are going to go in the money. Well, we can look at the probabilities here, and in the next month, I was telling you it's a, what did I say? I already forgot already. I think it was, I don't want to say it wrong, a $3.22 move. So $3.22 move on this, we can see 149. I am definitely going to be out of the money. Now, you can look at an option hack over here also, and this is, at expiration. which is a little bit longer than that 1 month away, and it's a $9 move. So still, in the next 31 days to expiration, $9 move expected. My 160 strike that I was talking about, that 16-ish delta, is still going to be out of the money. So whether or not we're looking at the finite, we can streamline the hack and look at our expected move for at the end of the expiration cycle and still see that strike location that I'm looking for when we're selling premium is going to be out of the money. And then on the premiums that I was looking to buy, deltas, we can see that even then I'm going to be probably, I can't tell what that delta is on that one anymore. I might be getting tested on this, but the likelihood is that I would be out of the money, or I would be in the money if I was buying, right? Because the expected move would rally up, and these strikes have a good probability of being in the money, and we can see by the expected move that it is a high likelihood that those would be in the money as well. So we want to sell nearer duration because the expected move won't penetrate my strike location. And then when we're buying, we want to get further out in the duration and buy the strikes that have a good chance of being in the money. So we can look at the expected move, which is right here next to the volatility. Or you can kind of drill down on that with the mathematical equation I'm looking at. But I like to go for the ones that is pretty easy to understand and easy to look at. But that's why I like to pick those strike locations for those different underlines. All right. I got ahead of myself on that, so I'm going to skip. That's why I was going to say, why is it important? Basically, I kind of just showed you a little bit ahead of time because of the probabilities of those strikes being in the money. This is a little bit easier to see. Those 17 will not be likely in the money by our expected move. The 23, you can see that these 36 deltas are likely to be in the money. But same strike location, but we want to be buying further out in time, limits our theta decay. We get volatility, expansion helping us, getting a little in the weeds here. But the ones that we want to sell are the nearer duration. That volatility will likely come out because we sold at high volatility. We've got theta helping us out, a lot of different things working in our favor, and the probabilities are going to be out of the money. All right. I talked a little fast. I'm going to probably have a little bit extra time for the 44 was the IB. Yes, 44 was the IB. Multiplying, because why are you multiplying by the 52.62? That was the price of what the underlying was trading at in that screen there. So let me go back to that real quick. Where was that slide? So in this slide right here, we were looking at the underlying. Probably should have had that not covered up in the next slide. So I used this number where the underlying is trading. Let's just say it's XYZ. All right, and I multiplied it times the implied, or divided that number by the ratio, the 44. Let's say, for instance, I did the 44 divided by the the 7.22, right, and then multiplied, took that and multiplied it by the 2562. I don't know why it's not wanting me to write over there. And now it's really going crazy. Does that make sense? I can give you another example if you like. So for instance, right here is the implied volatility. We would then divide that by the 7.22, right? And then multiply that sum by the price of what the underlying is trading. That gives us our expected move. that make sense? Cindy? Gerald? Yes, looking at today's implied volatility and figuring out where the day, the month, and the week expected moves are for that duration, that we're talking about, whether it will be a week, a day, or a month. And this tells us, another way of telling us how volatility, and this is the expected move plus or minus during this exact expiration cycle, or 120 days. The underlying is expected to move $23. All right? So we got it, right? We know easily how option premiums, when they're expensive or when they're cheap, the probabilities will help us stay calm, right? We know if we buy an option strike where the probabilities of being in the money are like 31%. Yeah, that's not huge, but we know 2 times that probability will get us at least tested, right? So we got a good probability of doing that. And why we're picking those strike locations? The best strike locations, I believe, are buying the 31 delta in the near duration, buying the 31 delta in those further duration options, and selling like the 16 delta in the near, inside of 35 days to expiration, buying the options that are just outside of 71 days to expiration. So that's usually the wheelhouse I look at for those. Yes, the expected move on the last day during that, it gives you the exact days to expiration. That is the expected move for that. What I'm looking at for a day, a week, it's kind of given us 5 days, 1 day, 5 days, and about 20 or 30 days to expiration is kind of the month. So if the option montage has given us 45 days to expiration, it's given you the exact finite number there where it's done the math for that. If you divide the expected move by the days to expiration by the number of days, would that give you the same calculation? No, I don't believe it would. Anybody else have any other questions? I know I finished a little bit quickly. How does the IB percent play into this? When we're doing the IB percent, I'm going to go back to a chart real quick, so I'm going to try and scroll and find that. The IB percent, when we were talking about, let me see if I can erase everything. All right, so IB percent, I believe you're talking about where you say the current IB minus the low IB, right? This whole thing gives us IB percent, right? And we divide that sum by the high IB minus the low IB, right? So basically, IB percent, if I were to do this math on this, right, it would tell me where implied volatility is, because this is implied volatility. And it is a percent. Forget about that. But what I'm talking about is that implied volatility right here is in relation to this low and this high. Now, we talked about like discounting those, but what we're trying to discern is, this could be in about the 15th percentile, this being the 0 percentile, and this being the 100 percentile, right? So the idea is that when it's really low, the market, the underlying is, or the volatility is going to want to revert back to 50. All right. So when you're right at an IV percent of 50, it's a pick'em, right? You have to decide, do I think volatility is now going to come out, or do I think it's going to continue to go higher? But when it's at extreme lows like this, you know it's pretty darn low, and that means that those premiums are pretty cheap. So the idea is you would want to buy volatility or buy the option premium with the expectation of the market moving higher. Why? Because if I'm even directionally wrong with the buying premium, but I get that volatility coefficient increasing, that means my premiums are increasing, right? And we can see that, you know, just a move in a matter of days of volatility coming out, if we were to have sold up here the premiums when they were expensive, well, even if I was directionally wrong, like I had maybe sold some calls right here, if we look straight up to the chart and it traded sideways here, if I had sold some calls here and the market started creeping higher, I was directionally wrong, but this volatility coming out is dramatic. And, you know, every 1 percentage point move in volatility, our premiums are going to be adjusted by that Vega coefficient. So we could see like $1 or so come out of our premiums based on how much volatility comes out, and that would counteract any directional move we had against us. So the idea is you want to sell up here when premiums are expensive. It will help you, even if you're directionally wrong. That premium comes down by the volatility. You sold volatility, and you created a good strike location at that 17 delta. You can see yourself making money despite the fact that you were directionally wrong. And again here, you know, premiums increase. If you're directionally right, you get double bang for your buck. Your premiums are increasing and you got the directionality right. So the idea is, you know, finding the percent, anything below 50 on a stock, we want to be buying premium. Anything above 50 is where you would be looking to sell premium. So based on probabilities, you're looking to buy the 31 delta and selling the 16 delta. When I'm buying premium, I'm going out 75 days to expiration. Okay. I want to get out further on the time horizon because I want to limit that theta decay. Also, volatility affects further duration options. So if I'm buying it really cheap and I get that volatility expansion, I get helped out for that. When I'm selling an option, I want to go closer to about, you know, inside of 35 days to expiration. Why? Because then I get the theta, the thief in the night that comes and steals my premiums. He's helping me out, right? He's getting more and more aggressive every single day, stealing my premium. So when I sell premium, I want to go to that 16 delta and take advantage of that thief in the night that comes and steals my premium. So selling 16 delta inside of 35 days to expiration. Buying, if the premiums are cheap, I want to go about 70, 75 days or more out in time to buy at around that 31 delta. That makes sense? Okay, perfect. Anybody else have any? You're welcome. All right, one other hack I got for you guys. If you guys want to do a real quick bonus hack here, anytime you're doing a pairs trade, like buying one stock and selling another one, an easy way to figure out how many of one stock is, you know, say you had a $100 stock and a $50 stock, you basically want to take the $100 stock. It's always the larger stock. So you would say, you know, a $100 stock, and you want to pair it against a $50 stock. Well, basically, that means you want to buy 2 of stock B, all right, for every one of the stock A that you sold. So it's a good quick way to figure out what your ratio is, stock A divided by stock B on that. So if you go out 75 days, how do you project the option move using your formula? On that one, I'm just probably going to look at, on that one, I'm going to look at the expected move on those next 75 days. So do you compare the IVs on the pair trade? Yes. That bill we're going to be digging into a little bit more time than what we have here. Yeah, on a debit spread, it's close to buying the 31 delta and selling the 16-ish delta. Yes, it ends up being like that. Yeah, I usually say it's closer to the 20 delta that I'd be selling though. Well, if it's Cindy's saying you can't always get a whole lot of premium on the 16 delta, you're right, especially on stocks less than a $50 stock. It gets a little bit pennies, but you'll notice that when you have extremely high volatility, especially when it's up at the upper range of that, 75% or whatever, that those premiums are going to be pretty chock full of premium. Obviously when it's at the lower end, those 16 deltas are almost nothing, and they're going to be very close to where the underlying is trading. So that's why you want to stay away from that too. Gary, how do you select the underlying stocks for the pairs? We can talk about that. You can reach out to me. I'll go into that a little bit further down the road, but I don't want to dig into the weeds there with that right now. Sorry. The larger stocks, so a larger stock, I mean like $100 stock. Always put the more expensive stock, I should say. The more expensive stock is stock A on the upper end, and the cheaper stock is below. All right, guys, this is an offer we're giving you guys today, how to set up your option screen. Learning to trade options like I do. I talk about all kinds of stuff, the market profile, protecting your portfolio, digging into the nitty-gritty of that, how to set up your option screen. I have different option screens that I like to use that I have set up. Even the watch list to that point. You guys can get the script for me on the side of my trading platform. I have the watch list. I list everything with high implied volatility percent to low implied volatility percent, because when I'm doing an option strategy, I'm flipping through the charts like you guys are, using that watch list, and then when I find a good setup, then I'm looking over there to see where the implied volatility percent is in order to discern whether I'm going to be buying an option strategy or selling an option strategy. So that's really important. I go into the devil of the details on that. So you guys can take advantage of this. I believe Becky is putting that link there in the chat window for you, so you guys can take advantage of that. We're giving you guys, it's usually like $970 or $997 for all of the webinars we have. It's basically over probably 15 hours of content. So we're going to give you guys a special trial here, or special for $36 while we're doing this. Also, if you have any questions, comments, you can reach out to us at 310-598-6677. And that's about all I got for you guys. I'm sure they have a disclaimer. They kind of show you that we're not trying to, here at Pro Trader Strategies, I'm not trying to get you guys to lemming off the cliff with me. We are an educational company. I'm just trying to give you guys high probability trades so you guys can increase your success rate. All right? Thanks very much, Becky. I appreciate it.
Thank you, Eric. Good stuff.
Yeah.
Everybody try Eric's information. This is stuff that puts you ahead of the game, at least gives you a high probability platform to be trading from. This is coming from somebody that has been on the floor, so You want to take a look at this information. Eric, good stuff. We appreciate you being here tonight.
Thanks, Steve. I appreciate you having me on tonight.
All right. Okay, everybody. Have a good evening. We will see you all in the chat rooms.